Investing is often seen as a straightforward path to financial growth, but the reality is far more complex. Many investors, both new and experienced, fall into costly traps that significantly erode their wealth over time. These mistakes are not always obvious, and even the most intelligent individuals can make them if they don't approach investing with discipline, patience, and a deep understanding of market behavior. The most common investing errors often stem from emotions, misinformation, or the pursuit of quick profits, leading to decisions that can set an investor back years. One of the most frequent mistakes investors make is chasing trends and hype. Many jump into investments simply because they see others making money, assuming they are missing out on an easy opportunity. This phenomenon, often referred to as FOMO, fear of missing out, drives people to buy assets at their peak prices only to suffer losses when the market corrects. Investors who follow the crowd without understanding the fundamentals of their investments often end up buying at inflated prices and selling at a loss when the hype fades. True wealth is rarely built on speculation. It comes from making informed, strategic decisions based on solid financial principles. Another major mistake is failing to conduct proper research before investing. Many people invest in stocks, real estate, or other assets without fully understanding the risks involved. They rely on tips from friends, social media, or so-called financial gurus without taking the time to study market conditions, company financials, or long-term economic trends. This lack of due diligence leads to poor investment choices that may appear promising on the surface, but lack the fundamental strength to deliver lasting returns. Blindly following advice without verifying facts is one of the fastest ways to lose money in investing. Short-term thinking is another common pitfall. Many investors expect quick profits and become impatient when they don't see immediate results. This mindset often leads to impulsive buying and selling, which can be disastrous in volatile markets. Instead of allowing their investments to grow over time, they panic at the first sign of a downturn and sell at a loss. True investing success requires a long-term perspective, as the greatest returns are often realized by those who stay the course and allow compound growth to work in their favor. The ability to remain patient and ignore short-term fluctuations is what separates successful investors from those who struggle. Ignoring diversification is another mistake that can lead to significant financial losses. Putting all of one's money into a single asset, stock, or sector may seem like a good idea when that investment is performing well, but it creates a dangerous level of risk. Market conditions can change suddenly, and even the most promising investments can decline due to unforeseen circumstances. Investors who fail to diversify their portfolios expose themselves to unnecessary risks that could have been mitigated by spreading their investments across different asset classes. A well-balanced portfolio is essential for managing risk and ensuring steady, long-term growth. Emotional investing is another major factor that leads to poor financial decisions. Fear and greed are two of the biggest drivers of market behavior, causing investors to make irrational choices. When markets are booming, greed pushes people to buy without considering whether prices are justified. When markets decline, fear drives them to sell, often at the worst possible time. Successful investors learn to manage their emotions, making decisions based on logic and strategy rather than reacting to market swings. The ability to stay calm during market fluctuations is crucial for building lasting wealth. Lack of risk management is another mistake that can be costly. Many investors enter the market without a clear strategy for protecting their capital. They take on excessive risk, assume they will always be right, and fail to have an exit plan in place. Without proper risk management, a single bad investment can wipe out years of gains. Smart investors understand that losses are a part of the investing journey, but they take steps to minimize their impact through careful planning, setting stop loss limits, and maintaining a diversified approach. Overconfidence is another silent killer of wealth. Many investors believe they have superior knowledge or instincts that allow them to outperform the market. This often leads to reckless decision-making, excessive trading, and ignoring valuable advice. Markets are unpredictable, and even seasoned investors can make mistakes. Those who remain humble, continuously educate themselves, and adapt to changing market conditions are more likely to succeed in the long run. The desire to build wealth quickly has led many investors down dangerous paths, chasing unrealistic promises and falling for the illusion of easy riches. The idea that wealth can be built overnight is a seductive one, but in reality, very few people achieve lasting financial success through shortcuts. The illusion of quick riches is fueled by media stories of overnight millionaires, viral investment trends, and the constant noise of social media, where success is showcased but failures are rarely discussed. This creates a false perception that rapid financial gains are not only possible, but also easily achievable, leading many to make impulsive and reckless investment decisions. One of the biggest drivers of this illusion is speculative investing, where people pour money into assets based on hype rather than fundamentals. Cryptocurrencies, meme stocks, and speculative real estate ventures have all seen dramatic rises and crashes, leaving many investors with massive losses. When people see others making huge profits in a short period, they assume they can do the same without understanding the risks involved. The fear of missing out causes them to buy at inflated prices, only to watch their investments plummet when the hype fades. While a few lucky individuals may strike gold, the vast majority end up losing money because they entered the market with unrealistic expectations and no clear strategy. Another dangerous aspect of the illusion of quick wealth is high-risk trading strategies that promise massive returns but often result in devastating losses. Day trading, options trading, and leverage investing can be highly profitable for a select few, but for most, they lead to financial ruin. Many people underestimate the complexity of these strategies and overestimate their ability to time the market. The emotional highs and lows of rapid trading often lead to poor decision-making, causing investors to chase losses, double down on bad bets, and ignore warning signs that a market downturn is approaching. Unlike true investing, which is built on patience and long-term strategy, these high-risk approaches are more like gambling than wealth building. Get-rich-quick schemes also contribute to the widespread belief that wealth can be created effortlessly. Multi-level marketing schemes, so-called passive income programs, and fraudulent investment opportunities prey on people's desire for financial freedom. These schemes often promise extraordinary returns with minimal effort, luring in those who are desperate for a shortcut to success. In reality, most of these opportunities benefit only the people at the top, while leaving the majority of participants with losses. True wealth is rarely built through secret formulas or exclusive deals. It is built through discipline, education, and a commitment to sound financial principles, which aren't actively working. True wealth is not built where most people think. Many believe that financial success comes from high salaries, striking it big in risky investments, or chasing the latest hot market trend. But real lasting wealth isn't created through quick wins or speculative gambles. It's built in places most people overlook, through habits and strategies that stand the test of time. The biggest difference between those who achieve financial security and those who constantly struggle is not luck or intelligence, but a deep understanding of where real wealth is actually created. One of the most fundamental places where wealth is built is through ownership, owning assets that generate income and appreciate over time. While many people focus on earning more money through their jobs, the wealthiest individuals understand that true financial freedom comes from owning assets like stocks, real estate, and businesses. Salaries alone rarely lead to financial independence because they require continuous effort to sustain. Those who prioritize ownership over simply working for money create a financial foundation that allows their wealth to grow even when they aren't actively working. Long-term investing is another key pillar of true wealth building. Unlike short-term speculation, which is driven by emotions and market fluctuations, long-term investing takes advantage of the power of compound growth. Investors who consistently put money into assets like index funds, dividend stocks, and rental properties see their wealth multiply over decades. The secret is not in timing the market or chasing short-term gains, but in staying disciplined and allowing investments to grow uninterrupted. Those who build wealth understand that time is their most powerful ally, and they let compounding work in their favor instead of constantly shifting their strategies in search of quick profits. Another crucial element of wealth creation is financial discipline. Many people mistakenly believe that earning more money will automatically make them wealthy, but without proper money management, even high earners can struggle financially. Those who build lasting wealth develop strong financial habits, such as living below their means, saving a significant portion of their income, and avoiding unnecessary debt. Wealth isn't just about how much money is earned, it's about how much is kept and reinvested. People who control their spending and prioritize saving and investing consistently over time are the ones who achieve true financial security. Entrepreneurship and creating multiple income streams also play a critical role in wealth building. Relying on a single source of income, such as a salary, leaves people vulnerable to job losses and economic downturns. Wealthy individuals understand the importance of diversifying their income, whether through side businesses, investments, or passive income sources like rental properties or royalties. The ability to generate money from multiple sources creates financial resilience and opens the door to greater opportunities for growth. Those who build wealth focus on creating value rather than just exchanging time for money. Mindset and financial education are also key factors in wealth accumulation. Many people fail to build wealth because they lack the right mindset and knowledge to make smart financial decisions. Those who achieve financial independence continuously educate themselves about investing, market trends, and economic principles. They understand the importance of patience, risk management, and long-term thinking. They don't get distracted by short-term market movements or media hype. Instead, they stick to proven strategies that align with their financial goals. The ability to make informed decisions separates those who grow their wealth from those who lose money chasing bad investments. Building true wealth is not about luck, shortcuts, or secret formulas. It's about strategic decisions, consistent investing, and disciplined financial habits. The wealthiest people understand that financial freedom is a long-term game, and they position themselves to benefit from the principles of ownership, compounding, and smart money management. In the realm of investing, patience and strategic planning are paramount for achieving long-term financial success. These virtues enable investors to harness the power of compounding returns and navigate market fluctuations effectively. Patience allows investments to grow over time, leveraging the power of compounding. By holding onto investments, individuals can benefit from market upswings and mitigate the impact of downturns, aligning with long-term financial goals and securing a stable financial future. Better financial education. Implementing a well-thought-out strategy is equally crucial. This involves setting realistic goals, conducting thorough research, and maintaining a diversified portfolio to manage risk. A disciplined approach helps investors stay focused on their objectives, avoiding impulsive decisions driven by short-term market movements. In summary, cultivating patience and adhering to a strategic investment plan are essential for building wealth over time. These qualities empower investors to remain steadfast amid market volatility, capitalize on growth opportunities, and ultimately achieve their financial aspirations.